Well, good morning and welcome to the bank. You all know Grant. He's the Deputy Governor and Head of Financial Stability. So let me make a few opening comments and then Grant will make some as well. New Zealand's financial system remains sound and the risks facing the system have reduced in the past 6 months. The outlook for the global economy has been improving, but political and policy uncertainty remains elevated and debt burdens are high in many countries. A sharp reversal in risk sentiment could lead to higher funding costs for New Zealand banks and an increase in domestic borrowing costs. New Zealand banks are seeking to reduce their reliance on offshore funding and have raised deposit rates. Dairy prices have recovered in the past 12 months, and most dairy farms are likely to have returned to profitability in the 2016-17 season. However, some farmers are carrying excessive debt burdens and remain vulnerable to a fall in income or an increase in costs. House price growth has slowed in the past 8 months in response to tighter loan-to-value restrictions, a more general tightening in credit, and affordability pressures in parts of the country. Residential building activity has continued to increase, but not enough to meet rapid population growth and the existing housing shortage. House prices remain high relative to income and rents, and any resurgence would be of concern. While the loan-to-value restrictions have increased banks' resilience to any fall in house prices, a significant share of housing loans are being made at high debt-to-income ratios. Such borrowers tend to be more vulnerable to any increase in interest rates or declines in income. The Reserve Bank will soon release a consultation paper proposing the addition of DTI restrictions to our macroprudential toolkit.
Okay, well, the banking system we feel has good capital and liquidity buffers and profitability remains strong. Also, the banking system appears to be operating efficiently compared with other OECD countries based on metrics such as cost to income, non-performing loans and interest rate spreads. Banks have generally tightened credit in light of funding constraints and the increasing risks around housing. They are seeking to limit their reliance on offshore funding and have raised deposit rates in order to try and attract more domestic funding. The Reserve Bank supports a cautious approach to foreign debt in light of lessons learned in the GFC. The Reserve Bank is progressing a number of regulatory initiatives, as well as the debt-to-income consultation paper that we're expecting to put out soon. We're initiating a review of bank capital requirements, and we've released an issues paper to help frame this work. And we recently concluded a review of the outsourcing policy for registered banks, and we and other agencies are currently considering the recommendations of the recent IMF FSAP, the Financial System Assessment Program of the New Zealand system.
You know, we've been pretty clear that we would want to see debt-to-income ratios as a macroprudential tool in terms of the toolkit available to the bank. But we've also been pretty clear over the past several months that we wouldn't use them if we had them at this point in time. So if we were in a situation where we saw house price inflation start to pick up again, and we also had debt-to-income ratios starting to increase again like they have over the past 3 years. So if they continued to rise or even remained at high levels while house price inflation was resurgent again, then they're the sorts of things that we would look at very closely.
Clearly, a conservative approach with capital adequacy will improve the resilience of the banking system to any shocks that come along. So, it's the basic buffer against insolvency that's in the system. It's really the central prudential tool that we have. So the review is looking to, ensure that we have a conservative approach and that we're conservative relative to peers. And also we want a simple regime as possible. We want to avoid unnecessary complexity. And unfortunately, there is a fair bit of complexity that comes through the international regime through Basel. So we have to find this balance compared to what comes through Basel and what's sensible for the New Zealand system.